Well, hello, everyone. Thank you for joining us once again. This is our third of 6 sessions of the 2024 Tennessee Farmers Market Bootcamp webinar series. I'm really excited today to have Dr. Margarita Velandia here to talk about things to consider when setting prices for direct-to-consumer market outlets. Pricing is such an important part of our marketing strategy and can definitely impact our profitability, but pricing is not all that easy to do when you get down to it. So I'm really excited for her to share some information about how to go about doing that. Just a reminder that participants are asked to please keep your video and microphone off. That helps us conserve bandwidth for our rural communities and also helps keep distractions to a minimum. We do want your questions and input, however, and you can put that in the chat box if you would like everyone to see it, or if you have a question or something that you just want Margarita and myself to see, you can put that in the Q&A section there, and we will be checking those as we go today. We do value your feedback, and I'll be including a link to access our evaluation form at the end of the session, and a reminder that that is also the way that we verify your attendance or that you watched the recording so that we can report to the Tennessee Department of Agriculture for Tennessee Agriculture Enhancement Program educational credit. If you have questions about that, let me know and we'll try to clear that up. So I do want to introduce Dr. Velandia to you. She is a professor in our Department of Agricultural and Resource Economics. Her research and extension programs focus on production and farm management decision-making. She prepares enterprise budgets for various agricultural cropping systems, conducts economic feasibility analysis of sustainable production practices, and develops decision aids to help farmers make informed decisions. Additionally, she investigates labor shortage challenges faced by U.S. specialty crop operations and the alternatives to overcome these challenges. If you were at the Pick Tennessee conference, she had some great sessions on labor considerations, and we appreciate her giving her time then and here as well. So Margarita, I'm going to turn it over to you.
All right, I'm gonna, again, stop my video to conserve bandwidth. Again, welcome everybody. As Megan said, I'm Margarita Velandia, and I'm a professor in the Department of Agriculture and Resource Economics. I'm going to talk about things you need to consider when setting your prices for direct-to-consumer market outlets, such as farmers markets and pick your own markets. And I will briefly talk about some pricing methods and pricing strategies. Okay. A common question we receive from aspiring and beginner farmers are, how much should I charge for my tomatoes? How much should I charge for my squash? How much should I charge for my blueberries? Setting the prices for commodity type of growers is kind of like a strange concept, because if you're selling corn or soybeans, you're actually a price taker, not a price setter. If you're selling produce through direct-to-consumer market outlets, you are a price setter. Profit is determined by being able to produce it for, of course, less than that price. Setting the price for your product should take into account 3 specific factors. So you have to start with your cost of production and marketing that product. It is obviously important to confirm that your price will cover your cost, and that will include both variable and fixed cost, and we're going to talk about that later. But when you figure out the price that will cover your cost, you're going to set your minimum or floor price for your product. If you cannot cover your cost, you probably should not be producing that product. Another factor is what the buyer is willing to pay for that product. This provides you with the maximum price you can set your your product for. The third factor is the price of competitors or competing products. So let's start with where can I find the information or tools that could help you estimate first your cost on marketing costs, what consumers are willing to pay, and what competitors' prices are. Okay, so first let's start with the cost of production or cost of marketing and production. So the University of Tennessee fruit and vegetable crop budgets are available at the link listed at the top of this slide. These budgets will give you some guidelines on the things you need to consider when estimating your cost. Additionally, we have the Tennessee Farmers Markets price reports. We report farmers markets prices every other week for an average of 5 markets across the state. The second link on this slide will take you to these reports. The price reports are a collaboration with the University of Kentucky, which is why you will find our reports on the University of Kentucky website. The Tennessee Farmers Markets price reports will allow you to assess what consumers are willing to pay for your product, as well as competitors' prices. In this slide, I have a list of all budgets that we have currently available on our website. How are these budgets different from other university budgets? We differentiate budgets by scale, not only by reducing the land area from 1 acre to 100 foot rows, but also by adjusting production and marketing practices. For example, the small scale budgets assume produce is being sold through farmers market and that a farmer at that scale will probably not be applying fumigants. Other universities have small scale budgets, but what they simply do is dividing all their gross revenue and cost by a specific number just to reduce scale. They do not change assumptions related to production and marketing practices. Another unique element of our budgets is that they provide additional information related to cost changes associated with using different production and marketing strategies. For example, in the blueberry and blackberry budgets, you can select different integrated pest management strategies and marketing strategies, such as a retail or pick your own. As I mentioned before, we report farmers markets prices every other week for an average of 5 markets across the state. In this slide, I'm showing an example of a price report for the week between July 10th and July 16th of 2023. We report a range of prices if more than one vendor is selling a particular product. For example, for green beans, we reported a price between $2 and $2.75 per pound. If different vendors are selling the product at different unit prices, we report prices for the different units. We also provide information about the number of vendors selling a particular product to more or less give a vendor an idea of the level of competition and consumers an idea of the supply of a particular product. Low implies that only one vendor is selling the product. Medium indicates that between 2 and 5 vendors are selling the product, and high indicates that more than 5 vendors are selling that product. This information allows you to assess both competitors' prices and consumers' willingness to pay for a product. Other universities also have budgets available on their websites that will help you estimate your cost of production and marketing. I personally recommend the University of Kentucky and the Iowa State University budgets or decision aid tools. On the left-hand side of this slide, you will find the link that will take you to the University of Kentucky fruit and vegetable budgets. Once you click on the small scale link, you can download an Excel file containing all available melon and vegetable budgets. Iowa State University also has small scale budgets, production budgets on its website. The second link on the right-hand side of this slide will take you to their Decision Aid budget tools. You can click on any of the vegetables listed on the website, which will automatically download the Decision Aid tool associated with that particular vegetable. They also have high tonal budgets available on high tonal vegetable budgets available on their website. The first link on the right-hand side of this slide will take you to those budgets. You will download the high tonal decision aid tools when clicking on the green square. This Excel file contains budgets for both multiple and single crop high tonal budgets. Okay, so now we know where to find the information, right? So let's go back to the principles that I need to consider when setting up my prices. Knowing the cost of producing and marketing a product is very important when setting up your prices. Specifically, computing the break-even selling price for your product is an important calculation when setting your sale price. It tells you the minimum price you can sell your product for and still cover your cost. The break-even sale price should be computed over a range of production and sale quantities using the formula I'm presenting in this slide. In the next few slides, we're going to go through two examples of how to calculate the break-even prices for tomatoes using the University of Tennessee and the Iowa State University tomato sample budgets. Okay, so as I mentioned before, the Iowa State University vegetable budgets are a good tool for evaluating how net profits change when prices and input costs change. These budget tools are divided into 5 sections. The first section illustrates the enterprise total receipts per 100 foot row, although this unit measure could be changed when you're actually using the tool. The second section is the cost of planting and growing the product. These costs are segmented for 2 reasons. First, these costs are incurred whether a product is sold or not. Once the seed is planted or weeding is completed, it is basically a sunk cost and needs to be covered from some source. The second reason is that there is a time delay between pre-harvest expenses and the time the product is sold. These expenses may have to be covered by borrowing, savings, or some other source. Therefore, interest on pre-harvest costs should be included as a production expense. The third section is the harvest component, and the fourth section relates to ownership cost. Each producer owns or controls assets that they use to produce income such as land, machinery, irrigation, equipment, and other items. Ownership costs are an allocation to realize some return for the use of these assets. In this example, we're assuming the land or the fixed cost of land is going to be $219 per acre. Assuming that in an acre, I could have 70 100 foot beds, that means that my cost per bed is going to be $3.13 per bed. Machinery investment is assumed to be about $11.19 per bed, or about $833 per acre. All right, the irrigation system we assume to be that needs to be replaced every 3 years for a total per acre investment of approximately $500. Therefore, after making all those estimations, my total ownership costs are estimated at $17.41 per 100 foot bed. The last section is the summary of returns. Total cost will be variable and ownership cost. The total cost will be that variable and ownership cost combined. The return over variable cost will be simply total receipts minus total variable cost. The return over all costs would be total receipts minus combined variable and ownership cost. Although this budget does not include marketing costs, I kind of like tricked the tool and included this cost in the labor section. So you can see in the harvest section, you can see in the harvest section, I put $522.38 as my marketing cost. And where did I come up with that number? I came up with that number using the University of Tennessee sample budget that I'm going to show you in the next slide. So if I use the formula from the previous slide on how to calculate my break-even price, I came up with a break-even price of $2.17 per pound. So you can see on the top when I set my price at $2.17 per pound, my annual return over total cost is gonna be 0, which means when setting my price at $2.17, I will be able to cover both my production and marketing costs, including both my variable and fixed cost. Now, we use the UT small scale tomato budgets to estimate another example on how to estimate the tomato break-even price. When using this budget tool, users can change all sales highlighted in gray. The sample budget is estimated for a 100-foot row of tomatoes. It is important to assess the number of products sold in the market, as the marketing costs are divided by the number of products you are selling through that market. Production costs will include things such as fertilizer, fungicides, insecticides, herbicides, labor, and marketing costs. Marketing costs will include my annual and booth fees associated with selling products at the farmer's market and the transportation cost. In this sample budget, we do not include fixed costs because equipment in small-scale operation varies greatly from operation to operation. But I know, and we'll learn today, that you should consider your fixed cost when estimating your net profits and when setting your break-even price. To consider fixed costs, we use the estimated ownership cost from the Iowa State University sample budget. As you remember from the previous slide, that cost was $17.41 per 100-foot row. And so I used that number as a reference and modified the break-even formula to calculate the break-even price so that we found a price that gives me a return over variable and marketing costs equal to the fixed cost. So you can see at the bottom that when I set my price at $2.40, my return above variable and marketing costs is going to be exactly equivalent to my fixed cost, which is going to be $17.41. All right. So once I know my break-even price, which is kind of like the minimum price I can set my prices at, you can establish a markup for each unit sold. That markup must be large enough to provide a sufficient profit, but it should not exceed what consumers are actually willing to pay. So in this slide, I'm showing various markup scenarios. You obviously might be tempted to go with the highest markup, in this case, the highest price. So if my break-even price is $2.40, I want to set up my markup at 60% per pound, which will give you a price of $3.84. The question you need to ask yourself is, will customers in my county or region will be willing to pay $3.84 per pound for tomatoes? The answer to that question is maybe yes, maybe not. It would depend on location and maybe the quality or type of tomatoes you are selling. So the next question you might be asking yourself is, how do I know how much customers are willing actually to pay for my tomatoes? The farmers market's price reports may allow you to identify average prices paid by customers at various farmers markets in Tennessee. For example, in this slide, I'm showing 3 graphs showing the average tomato prices between 2018 and 2023 in farmers markets in Hamlin, Knox, Rutherford counties. To create these graphs, I calculated the average between the minimum and maximum prices we report every 2 weeks for tomato varieties that are priced on a per pound basis. The price variation you see on these graphs is not because each farmer is actually changing prices on a weekly basis, but rather as the season progresses, more vendors come to the market and set their prices at different levels. I'm not differentiating tomatoes by variety, even though I know that, for example, heirloom tomato varieties might be sold at a higher price in some markets. Not all markets price their products using the same unit. Some price their products by the pound, while others price their products on a per container, like a quart. Farmers who are pricing products by the container believe pricing products by the container reduces transaction cost and speed up the payment process. I wouldn't disagree with them. I think this is actually a good strategy, as long as you're covering your production and marketing costs. In these graphs, I'm not reporting the prices by container because it is really hard to compare container prices without knowing the exact weight of those containers. As you can see in these 4 graphs, prices in higher medium household income counties such as Knox and Rutherford are traditionally higher than those prices paid in other counties with lower medium household incomes, such as Hamlin County. In 2023, the average differences in prices between Knox and Hamlin counties was about 86 cents, even though the markets are actually located in the same region. Another important thing to notice is that although the prices in all markets were about the same between 2018 and 2019, after the COVID pandemic, prices finally increased at all markets. Prices at Rutherford and Hamlin counties increased by about 40 cents per pound, while prices in Knox County increased by about 60 cents per pound compared to average prices between 2017 and 2019. Okay, so let's go back to, I already know my cost of production. Now I know what my competitors are setting their prices for tomatoes, and somewhat I know what consumers are willing to pay. So let me now compare the markup scenarios to actual competitor prices based on farmers markets price reports. So it seems that in the Hamlin County farmers market, the average markup is 20%, which allows them to cover the cost of production and sets a price that consumers are willing to pay. On the other hand, in metropolitan counties such as Knox County, the average markup is about 40%, given the higher willingness to pay of customers in Knox County compared to customers in Hamlin County. Okay, so in this slide, I'm showing an example of farmers markets prices for a product, specifically sweet corn, where in some cases, location does not actually determine price. Let's look at the graph at the bottom of this slide. You will see that although prices for sweet corn in Knox County are higher than in Hamlin and Rutherford counties, sweet corn prices in Hamlin and Rutherford counties are very similar, even though the median household income is higher in Rutherford County compared to Hamlin County, which you will think might imply that the prices in Rutherford County will be higher than the prices in Hamlin County. Well, that's actually not the case for sweet corn. In Knox County, the higher prices could be explained by not only consumers' willingness to pay in this case, but by the limited supply of sweet corn. So in 2023, I saw about really 2 vendors consistently selling sweet corn. And actually only one of those vendors was specializing on sweet corn, and he was selling the sweet corn by the ear, roasted, or by the dozen raw. We use the University of Kentucky small-scale sweet corn budgets to estimate the sweet corn break-even price. So we know how are my competitors' prices at the different farmers market. Let's go back and look at my break-even price. On the right-hand side, you can see a link to the University of Kentucky vegetable and melon budgets and a list of vegetable and melon budgets available on their website. The sample budget for sweet corn is estimated for 1/10 of an acre or about 1,100-foot rows of length of 36 inches. Production costs include seed, fertilizer, weed, disease, and insect control. It also includes labor and marketing costs and fixed costs. Marketing costs are estimated as 10% of the gross revenue. So in this case, they don't go on into detail about like if I was selling my sweet corn to farmers markets, they actually do not show you the marketing cost. They simply set that cost at 10% of the gross revenue. Because they set their marketing cost this way, it is actually hard for me to go back and use the equation I showed earlier to estimate my break-even price because the costs are actually a function of gross revenue. So what I did is I simply play with this budget and I found a price that actually will cover both my variable and fixed costs. So in this case, you see, so at the bottom, you see, I just tried to find a price that will set my return to land, capital, and management equal to 0. In this case, that price was $5.90 per dozen. Now that I know the minimum price to cover all my expenses, in the next slide, we will assess how to incorporate competitors' prices and consumers' willingness to pay to assess how much shall I be selling my sweet corn for. Okay, so when comparing my markup scenarios to competitors' prices based on farmers markets price reports, it seems that in Hamblin County, farmers markets, the average markup is about 20%, which allows them to cover the cost of production and sets a price that consumers are actually willing to pay. On the other hand, in metropolitan counties such as Knox County, the average markup is about 40%, given again that consumers might be willing to pay more at the Knox County farmers market compared to the Hamblin County. Now, let's look at that 60% markup scenario, which will set my final price at $9.44 per dozen. So I know my competitors' prices, right? Nobody's charging $9.44 per dozen for sweet corn. So I will probably need to avoid that markup scenario unless I'm growing this type of sweet corn that is very special and that justifies for me to have a premium price for that sweet corn. I also wanted to show you an example of how to assess prices when I'm growing multiple crops. There are not very many examples of multiple crop budgets. Iowa State University produced high tunnel budget tools. The link at the bottom of this slide will take you to the Iowa State University high tunnel budgets. Why for high tunnels is kind of like a different perspective. So enterprise budgets for high tunnels can help you allocate valuable space, labor, and capital for the most appropriate use. That most appropriate use may be, of course, to maximize your profits, could be meet your customer needs or any other goal you want to define. The estimated cost and returns shown in these tools are based on farm data that they receive from 5 high tunnels on different farms in Iowa between April and October. It is important to say that input costs will need to be updated since these tools were created in 2013. In this example, I only updated labor costs and I tweaked the tool to try to incorporate marketing costs associated with selling 8 crops in the farmers markets using the UT budgets and incorporating this information in the pest management labor line, since this cost was estimated as 0 in this example. Okay, because the high tunnels in the study varied by size, the budgets were developed on a per square foot basis. The various planting and cropping systems in a high tunnel, planting seasons, and management strategies used by growers also resulted in a wide range of profit potential. Okay, so I'm showing you on the right-hand side. On the right-hand side, I'm showing you the single crop high tunnel budget. On the left-hand side, I'm showing you the multiple crop high tunnel budget. The budgets are divided into 4 sections. The first section indicates the crop or crops budgeted, the size of the high tunnel, the approximate original cost, and the percent of that high tunnel utilized. The size of the high tunnel for all budgets is set for these examples at 30 feet by 72 feet or at 2,160 square feet. The approximate original cost of the high tunnel, which in this case is estimated at $7,000, does not take into consideration any rebates or cost share programs. The percent utilization represents the amount of square footage planted and harvested as a percentage of total square footage on a high tunnel. In this case, we set that up at 84%. The ownership cost section in this budget assumes that the high tunnel has an 8-year lifespan and that the plastic covering has a 4-year lifespan. The total ownership costs are estimated at around 46 cents per square foot, based on an approximately total high tunnel construction cost of $7,000 and a plastic cover replacement cost of 21 cents per square foot per tunnel, or $454 per 30 by 72 foot tunnels. Land rental and depreciation on machinery and equipment are actually not included in this budget. So you need to be aware that that's not included. You have to add it when estimating your cost, if you rent land or if you own machinery. The budget on the right-hand side, as I told you, so the left-hand side is the multiple crop. The right-hand side is the single crop scenario. On the single crop scenario, which in this case is tomato, I'm growing tomatoes on 94% of the 2,160 square foot budget. In this scenario, my break-even price is 54 cents per pound. Again, remember that break-even price is simply the price that will allow you to cover both your variable and fixed cost. So your annual return over total cost is actually 0. The budget on the left is the one where I grow 8 crops in 2,160 square feet tunnel, including in this case, cucumbers, eggplants, greens, herbs, lettuce, bell peppers, tomatoes, and cherry tomatoes. And I'm assuming I'm selling all these products through the farmers markets. In this scenario, I selected a set of prices at which I will be able to cover my total cost. As you can see in this scenario, the break-even price for tomatoes is lower than the one estimated in the right-hand side. So remember, in the right-hand side, my break-even cost was 54 cents. In the left-hand side is 45 cents. This means that on my left-hand side budget, I might be losing money on tomatoes or might not be covering my total cost of producing and marketing my tomatoes. But because I am growing multiple crops, the net revenue of some crops might compensate for my tomato losses. Okay, so in the previous slide, we identified a combination of prices for all the crops listed here that allows to cover all costs. Remember, those were my break-even prices. In this slide, I use information from the 2023 Knox County Farmers Markets prices reports to try to assess how to price my products based on consumers' willingness to pay and competitors' prices. I decided to use another pricing strategy called target return pricing. The target return pricing return approach involves computing a target rate of return on your investment in the business and adding this to your sale price. In this case, we're going to assume that my only investment in my business was the construction of my high tunnel. The cost of that high tunnel in this example is $7,000. I'm going to assume that my target return on that investment is going to be 34%. Therefore, my target return on investment is going to be $2,400. In the budget on the left, I set the prices in a way that my annual return over total cost was exactly that amount. Basically, my target gross revenue is the sum of all my total costs plus the required return on investment. In this example, I'm also showing a loss leader pricing strategy. Remember, as I mentioned in the previous slide, my tomatoes are priced at less than the normal markup in this example. So what happens usually at farmers markets, and this is a fact, I know customers are always expecting tomatoes in the market, but I also know that almost every single vendor in that market is going to have tomatoes. So the idea is that the customers will come to buy the leaders, in this case, the tomatoes, knowing that I'm losing money on those tomatoes, but will actually also purchase regularly priced items, in this case, for example, cucumbers, eggplants, greens, and lettuce. The scenario where you're going to be in trouble when using that loss leader marketing strategy is that if the customers only come and buy your tomatoes, in that case, you are going to be losing money no matter what you do. But again, it's a marketing strategy you can use. Now I'm going to go to a more complex example on things you need to consider when pricing perennial crops such as blueberries for multiple market outlets. As for other fruit and vegetable crops sold through direct-to-consumer market outlets, location plays a critical role when pricing my products. In this slide, I show an example of how the location could affect prices paid by customers in blueberry U-pick operations across the state of Tennessee. In this map, I show median income based on 2015 estimates for all Tennessee counties. The way you read this map is the darker green counties have higher median household incomes. The lighter green or yellow counties have lower median household incomes. I searched for U-picked blueberry prices, and I found 3 operations in Middle Tennessee with U-picked blueberries, specifically located in Williamson, Wilson, and Sumner counties, selling U-picked blueberries for between $3 and $4 per pound or $5 per pint. I also found 4 operations in East Tennessee, specifically in Loudoun, Greene, and Rhea counties, where U-pick blueberries were sold for between $2.75 and $3 per pound or $12 to $15 per gallon. As you can see in this map, those farms located in counties with higher median household incomes are offering U-picked blueberries at higher prices than those farms located in counties with lower median household incomes. Although it is important for me to say that prices could be affected, as we said, by consumers' willingness to pay and consumers' income, but also those differences in prices might reflect differences in cost across all operations presented in this slide. For example, the farm located in Loudoun County has self-pay and self-weigh stations, which might reduce labor and marketing costs and partially explain why they're setting their prices lower than other operations. Okay, so I use the UT Blueberry budgets to estimate revenue streams and net revenue information from the individual year spreadsheets. Again, so when you go to the UT website, you will be able to download a spreadsheet to estimate or to project your cost of production for blueberries. So you have an overall budget and you have individual year budgets. I use those individual year budgets in this case to estimate my cost of production and marketing. I assume this individual is going to be selling 50% of the blueberries using a U-pick strategy and the other 50% through farmers markets. I assume labor costs will increase at a 5% rate per year, which will be the highest cost when you're actually growing and marketing blueberries. And I'm going to assume that other input costs will stay the same for simplicity. The yields that I'm presenting on the table on the left are from yield assumptions based on variety trials. I assume prices, the prices I'm presenting on the left-hand side, on the table on the left-hand side, I'm going to assume that those prices are going to increase at a lower rate than labor cost. When selling produce through direct-to-consumer market outlets, your prices, of course, as I mentioned before, depend on consumers' willingness to pay for your product and, again, competitors' prices. What I have observed in the from some farmers is that the farmers maintain prices fixed for at least 2 to 3 years because they're afraid consumers will not be willing to pay higher prices. And that could be true as long as competitors do not raise their prices. So that means that you have to maintain your prices at a certain level unless you figure out a way to differentiate your product from your competitors' products. With this assumption, okay, so we have assumption of yield, we have assumption of prices, we have our tables on the bottom that are showing us our cost per year. So you can see on the table on the top of this slide, it will show you that you will not have a revenue stream until year 3. Again, when you plant your blueberries, they're not going to be actually in full production until probably year 4 or 5. You're not going to have yield until year 3, which means that you will have to invest about $15,000 for the first 3 years without including other investments related to land and equipment. So what I will suggest in this case, if you're looking at blueberries and blackberries, you have to set your prices in a way that you have a target return on investment that will be able to allow you to cover that $15,000 investment. And it is also important, not only for the perennial crops, but for the annual crops, to revisit your pricing and marketing strategies, hopefully annually, as cost and consumer willingness to pay will change over time. The 2 additional price strategies I see at the farmers market that I wanted to mention today is psychological pricing and quantity discount pricing. Psychological pricing is pricing methods that takes advantage of consumers' perceptions when they see product prices. For instance, pricing a product at 97 cents rather than an even dollar amount takes advantage of the perception that 97 cents is a greater deal. I have seen this strategy being used in the Knox County and Washington County farmers markets, where squash prices are set, for example, at $2.99 per pound or $1.49 per pound. Another strategy is the quantity discount. A quantity discount is given to encourage customers to buy in larger amounts, such as $2 each and $3 for 5. For example, in the Knox County market, we report prices from a couple of vendors using this pricing strategy. There is a vendor, for example, that sells 1 eggplant for $3 and 2 eggplants for $5. Gross margin should be computed on the quantity prices to make sure you are covering your total cost. All right. So in this final slide, I want to summarize some of the key things you need to remember when setting your prices for direct-to-consumer market outlets. Make sure you understand and know well your variable and fixed costs. When setting your prices, you will need to consider your cost, consumers' willingness to pay, and competitors' prices. All those factors will determine how to best price your products. I see how some vendors show up at the market to undercut others' prices. When setting prices low, you might have the idea that your product will sell fast, but that does not mean you're actually making money. Depending on the farmer's market location, some customers might not be looking at the prices, but actually quality, especially in farmers markets located in metropolitan counties. In this final slide, you will find links to the various resources I discussed during my presentation. And at this point, I will entertain any questions if there are any.
Margarita, that was very wonderful. I love seeing all the tools that you provided and the examples to help work through those. Mark has a question about whether you can swap the pepper for the tomato on the small scale budgets as well. You would be getting the same information for either crop.
So that's a very good question. I have not tried because we have a pepper budget, but it's on a 1 acre scale. Technically, you know what, Mark? Yes, especially if you are selling, for example, for the farmer's market, your marketing cost is almost like a fixed cost. Your annual booth fee and your annual fee and your booth fee will be the same regardless whether you're selling tomatoes or peppers. And then you think about the production practices and are very similar. You're actually going to be looking at using plastic mulch, for example, if you're using plastic mulch. The only thing I see different is that you're not going to use, for example, sticks. You're not going to have a trailing system for your peppers, but for your tomatoes. So it is actually a good exercise, and I think you can use them. And I will be happy to walk you through that process if you email me. So I think you can do that.
It is so wonderful, the tools that are available now to help plug in. We used to do those in create your own spreadsheet models, and that's really helpful. Are there other questions for Margarita? We will, I'll ask Margarita if you would send me a PDF of your slides. I could email that to the registrant so they could have all those links. And I'll try to put some of those in the follow-up email as well, Tony, because there were a lot of good ones that I know people are going to want to explore.
Yeah, no, I'll be happy to share that with you.
Wonderful. We can wait for a few minutes for any questions. If not, I put the evaluation link. Please take just a minute and do that right now before you go. And we hope you have a wonderful weekend coming up. Don't forget to join us on April 1st. We'll be doing a regulatory roundup, trying to cover a lot of regulations all at once, talking about business license, sales tax, meat, poultry, egg sales, milk at the market, and anything else we can fit into an hour.
Megan, I see some people saying that they have the tools. If you run into any problem using I created those budgets, so I will be happy to update or walk you through how to use the tools so that you can estimate your own. The one caveat that we have is that we don't have those multiple crop budgets, but that Iowa State University is actually very useful. And yeah, it's specifically for high tunnels, and that the only thing cost is your ownership cost, because they assume that $7,000 investment. But if you wanted to focus on your variable costs, you actually can use that multiple crop budget and you will be good. Again, feel free to email me or contact me if you want to I'll walk you through and we can work together on how to make those budgets better.
Wonderful, Margarita. We appreciate your time so much, and you do such great work in this area, and also on the labor issue. If you haven't seen her work on the H-2A programs and other labor considerations, we can connect you with her for those. Donna has a great question. Will you be doing any budget for hydroponics, or do you know of any that would be helpful?
That's a very good question. Not very many universities do hydroponics. I can, Donna, I can, and I know you, Donna, so I can send you the ones that I have. We do have a project of control environment agriculture currently. And so we actually are going to be having to develop budgets for lettuce and some greens for hydroponics. I cannot promise you that's going to happen within the next year because we're collecting data from hydroponic farms. So what I usually do is I look at farmers that are doing the production system and I use that as a reference. Eventually we're going to do that, Donna, probably next year, but I will be able to send you what I have found so far, if that's helpful. Okay, great.
Sounds like that may be a top popular topic for others as well, Margarita. Neat.
Yeah. Mm-hmm.
Have there been large differences in pricing strategies between organic versus standard growing methods?
No, Jeremiah. So that's very unfortunate because I see, especially I'm gonna talk about farmers market. I cannot talk about other market outlets. Unfortunately, what I see is that farmers see what other farmers are pricing their products for, and they pretty much, like if somebody said the prices at $3 per pound, everybody follows. So I have a particular vendor that is organic certified at the Market Square Farmers Market. And when I compare his prices to other prices, he's not setting the price for that premium. And it almost like over time, what has happened is that consumers, especially at farmers markets, value more that relationship with the grower and knowing how they grow their products. They don't really care about is it certified or not. They just said, I trust you. If you tell me that you're not spraying, that's what I see customers in the market saying. Do you spray your tomatoes? So they don't really care about that certification, at least not in the markets where I collect prices. And yeah, I don't see price premiums for organic produce. Unfortunately, that's what I've seen.
That's very valuable observations because it costs a lot of time and money to get those. So if those really aren't making a difference in pricing at the market outlets you plan to use, then you know whether you need to do that or not.
Yes, I see differences in prices more on varieties. So I see heirloom tomatoes or specific varieties that actually consumers are looking, or products that are unique that nobody else has. But if I have the same tomato and one is certified and one is not certified, I don't see a difference in price, unfortunately.
A treasure trove of information here, Margarita. Thank you so much. And I know I will be digesting some of this, and you all maybe as well. So please take Margarita up on her offer. If you have questions that come to mind later, let her know. That would be great. Thank you all so much for joining us again. Thank you, Margarita. And we look forward to seeing you back next week, and we'll talk in the last 3 sessions about various regulations.